to move it across first.
Hello and welcome to this week's BizSmart Lunch and Learn webinar. Our weekly webinars are aimed to provide advice and share knowledge amongst business owners, and this is part of our service to our Smart Room members. If you're not already a member or a BizSmart client or would like to access our archive of webinars, then please visit our website biz-smart.co.uk and go to the Smart Room page. Our host joining me today is BizSmart founder Kevin Brent. But before we start the webinar, can I ask you all to use the question mark function on your screen to post any questions that you may have for Kevin, and he will do his best to answer them all at the end of the session. Thank you, Kevin. Over to you.
Thanks, Caroline. Right. Okay, so this time around we're going to take a look at our profit and loss statement, at our P&L. We probably all have a pretty good understanding of what a P&L is, but I'm just going to explore a couple of tweaks to it to make it work a little bit harder for us and make it a bit smarter, as we might say. So we talk about 4 key pillars of scaling up business. We talk about working on strategy, people, execution and cash. Obviously this one is around the cash side, and almost by definition we're going to be talking numbers, and it may be that I've tried to make it nice and simple, but it may be a little bit harder than some of the others, and it may be that what you want to do is to listen back to 1 or 2 of these things afterwards and have a look at some of the numbers that we talk about. So hopefully your head won't hurt too much when we go through this, and even if it sounds a little bit complicated in 1 or 2 points, the basic principle is simple. What we want to do is to tweak the P&L statements that we would typically get from our accountant to remove a couple of distortions that make it difficult for us to make good business decisions with it, but also to help us to work out the efficiency of our workforce, of the labour that we're putting into it, so that those 2 things combined, we can start to set ourselves some sensible profit targets that will help us to scale up the business as we go. So everything that we do in these webinars, what we're trying to do is to take any theory that's out there, sort of kind of take the theory out of it really and make it practical and relevant. This is no exception. But what you might find is that this particular webinar is going to be more applicable to those of us that have got businesses and that are probably a couple of £100,000 turnover plus, and that are really looking to scale our business and probably to take on people. If you're running a lifestyle business, it may be less applicable to you in that case, and the basic P&L may be all that you need to think about. So while we talk about this, well, what we find with businesses scaling up is that there are often 2 key weaknesses. One is the marketing, so yeah, finding the business, but the other key one is the accounting side of it and keeping track of the numbers. Many of us see the accounting as a necessary evil, if you like, something that is just simply really there just to keep the tax amount at bay, minimise the amount of tax that we pay, and many of us probably do little more than glance at the P&L. Maybe we'll certainly do it once a year, maybe a little bit more frequently for some of us than that, but probably don't use it in the way that it could be used to really help to help us make business decisions. So I think it comes to the same same sort of thing when we think about paying for our accounts or paying for our bookkeeping. We see it as an expense that we could save if we want to. Let's put the money somewhere else into helping us to grow our business, and actually the returns in terms of profits and cash in investing a little bit more of your time perhaps, or maybe outsourcing it, and the attention, putting more attention onto the accounting, that return can be really quite significant. And if you're trying to fund your growth and get yourself a decent pay packet, it can be essential out of it, certainly if you're trying to build a valuable business at the end of the day. So let's take a look at a typical P&L, typical profit and loss, and this is probably what you're very familiar with. So you've got your revenue, your sales, whatever you want to call it, at the top, and typically we take from that our cost of goods or our direct costs to give us a gross margin in terms of pounds, or wherever you're based in whatever currency, and then we probably would look at that as a gross margin percentage that's left, and from that then we'll have our fixed costs, our operating costs, of which there'll be several lines. You'll have your marketing expenditure in there, you'll have rent and rates and all sorts of stuff within there, and all of those added up, taken away from the gross margin, gives you your pre-tax profit, which you'll then probably do a percentage of that as a percentage of the sale. So that's the typical basic P&L. One of the troubles with that is that we could have two identical businesses and we could have two quite different looking P&Ls. There might be similar at the top and the bottom, but what's in between could be quite different. In fact, they can vary at the bottom there because there are a couple of things, as I'll talk about in a minute, that might vary even within the P&L. As I said before, they're put together largely to minimise tax or maybe for some other agenda, but the P&L will probably not have been put together by your accountant with the view of trying to help make good business decisions. It would be much more have been put together with the view of reporting in the way that you need to report. So it can have distortions within it, and there are two key distortions that we see that make it difficult to really work out what's going on. And the first is the owner's income. So how you treat what you pay yourself, whether it's you as a sole owner or whether there's two or three of you as shareholders within the business. And the other is the way that the gross margin is calculated. So the first thing we need to do is to think about clearing those distortions. And that's why, as I said in the title of this webinar, we need two books. And that's two books for the right reasons. It's not to hide the real stuff that's going on, but it's not to hide anything. In fact, it's quite the opposite. What we want to do is we want to reveal what's hidden perhaps within the basic P&L. So let's take a look at the owner's compensation first. So the basic thing we're doing here is we want to restate P&L using market wages for the owners. There's not many owners that I know that actually pay themselves what it would cost them to have somebody else come in and do that job. Now, from a tax point of view, that's fine, and we put some in dividends and whatever, but we're not paying ourselves at the market rate. So that clearly distorts the P&L, and it will lead us to thinking we're making a much bigger profit at the end of the day than we really are. So we might kid ourselves we've made a 20% profit, but we've only paid ourselves minimum wage, and therefore we're going to have less focus on that profit line than if we actually restated it, gave ourselves the right market rate, and when actually we're not making 20%, we're only making 3%, or in some cases maybe a loss, but at least that will then make us think about making as much effort as possible to improve the profitability and really focusing on 3% is not enough, guys. Come on, let's really work on that. And what's more, if we talk about building value within your business, certainly if somebody from outside was to come in and do a valuation of your business, whether that's a potential acquirer or you just want to do a valuation of business, some of you will have heard talk about multiples of your net profit or your earnings before interest, tax and depreciation. Typically EBITDA is what's used. That will have to be, and typically businesses can be worth 3 to 4 times, on average 3 to 4 times an EBITDA, with obvious exceptions. But if you just went, oh yeah, I'm making 20% profit, that's my EBITDA, and multiplied by 3 or 4, but you haven't allowed for your owners correct compensation within there, that will be a vastly inflated valuation of your business, and anybody looking to buy your business would just strip that out straight away because they would have to replace you. So the first thing is to restate your P&L using the market rates for the owners, and then asking ourselves the hard questions about how we get the profit to where we want it to be whilst being able to pay us the market rate salary. Right? Sounds easy. We know it's not easy to do, but that's what we need to do, so restate the P&L. The second I mentioned is about redefining the gross margin, because that's where the second big distortion is. And nearly every business owner will talk about revenue, as that's what they'll say, we turn over this amount of money. But equally, every business has also heard the saying about sales being vanity, but we still tend to focus on it. And different businesses we'll have a completely different setup from that gross margin point of view. So if we take a distributor turning over £4 million of product that's basically passing through and they're making a 5% commission on it, it's clearly very different from a service company that's turning over £4 million. So instead of focusing on revenue, we should really be focusing on a redefined version of the gross margin, because with some businesses, that gross margin is effectively the top line of the business, because the rest of it above that is just simply vanity. It's just simply a pass-through. You know, you're a estate agent, you're selling a house for £2 million, and you put that on your for that goes onto your revenue line, but you're only, you know, that's not really part of your business. You're just making the margin on the commission that you've made. So that's where your top line really should be. So instead of focusing on revenue, we should be focusing on a redefined version of gross margin. And why do we need to redefine that? Well, because again, we can get very different gross margins depending on how we define that. So gross margin, typically you will understand it as being the sales revenue minus the variable or some variable or direct costs, whichever your term you will have heard. But basically any costs that vary per pound's worth of sale that you make. So if you buy a widget for £5 and you do some work on it, both labour, £2 of labour or something, and you might, that's then your cost of goods going to be £7 out of your 20, so your gross margin is 20 or 65%. But the trouble here, and that's typically how it's done. Right? The trouble with that is that we've mixed up in that cost of goods, we've mixed up those direct costs, we've mixed up the labour costs and the material costs, so we can't measure any efficiency stuff. So if we want to look at measuring the efficiency, then we can't do that, and that's one of the things that we want to do. So the goal of where we're trying to get to here is that we can actually have some proper numbers that we can set profit targets on, and that we can monitor our efficiency of labour. So as I said before, this is where it starts to get, those of you that don't like any equations and things, we're going to see a couple of equations, so bear with it, it's not that complicated. So what we want to do with the gross margin is we want to redefine it as being the revenue as before, but subtracting all of the non-labour direct costs. So instead of mixing the labour in here, let's just take those, let's not include those in this, so let's just take out effectively the cost of materials. Okay, so then, but also if you are a service company and part of your business model is that you always subcontract certain elements, so if you're an accountant, you always subcontract the bookkeeping and you pay per job done or whatever it might be, then that effectively is cost of goods. We don't count that as internal labour, so that would be a cost of goods, so we would take that out of here. So what we're trying to do here is to separate out our internal labour costs here so that we can look at that separately. So if that was a bit complicated, have a listen back to it later on and have a think about it. And then now what we've got is we should have a measure of gross margin that is free from the distortions that I talked about. And if we've also in our P&L taken out the distortion of the owner's salaries, we should have a true measure of profit at the bottom, and we can start then to think about setting those profit targets. And as I said before, we should focus on the gross margin and the net profit rather than the sales being the vanity side. Now we also need to decide whether we calculate our net profit as a percentage of revenue. When we're looking at the percentage of it and we say make a 5% net profit, well, is that of revenue or is that of gross margin? Because again, if with that estate agent or with that distributor, if we were to define our net profit as a percentage of the revenue, it would look tiny. You know, it would be 2% or something like that. And that's not a true reflection of how we're operating our business. It's probably much, much better than that. So actually, although you will always probably have thought about doing your net profit as a percentage of revenue, if you're running a business where perhaps your gross margin is, you're operating at less than 40% gross margin levels, then you would be better off redefining that net profit as a percentage of gross margin, because then a couple of things I'm going to talk about in a minute will make sense and will hold true. If you don't do it, then the guides I'm going to give you won't hold true. So think about that. If you operate the kind of business where basically there's a lot of pass-through costs, your gross margin is low, think about reporting your net profit as a percentage of gross margin and using that gross margin as basically what you would have thought as perhaps of revenue before. So why does this matter? You know, this just sounds like moving numbers around for the sake of it. Well, here's that guide that I was talking to you about. And this comes from a book called Simple Numbers, written by Crabtree. And basically, if you redefine in the way that I've just talked about, if you've got a profit margin, pre-tax profit margin of less than 5%, then effectively your business is on life support. That's what he would say. Okay. If your profit margin is 10%, then that's fine. That's good, but there's untapped potential in your business. If you've got a net profit of 15%, then your business is in great shape. If it's greater than 15%, well, hey, fantastic, but make the best of it while it lasts, because it isn't going to last, because the competition will spot that. You will face increased competition. Something will change that will reduce that over time. So that's a really neat little guide, because that gives us a framework as to how to scale up. Because what we're saying now is, if we're not at 15% profitability, then scaling up and certainly taking on people as we scale up is risky, because we haven't got a business that's in great shape and able to cope with the stresses and strains of scaling up, and we're taking a high risk, and this is where businesses can start to overtrade. So the focus should be to be able to prove that we can get our net profitability to 15% with the volume that we have and the mix of people that we have, or at least the cost that we have within the business. And then once we're at 15%, then we can think about adding in some labour costs that might drop us back down to 10%, and then we improve our productivity and efficiency to get back up to 15% again, and we repeat. So it gives a framework as to how to scale up in a steady and sustainable way, instead of just going or trying to take on people because you think, actually, if we just took on more people, we could to satisfy the more business, we could grow and whatever. But if your profit margins are not where they need to be, you're just going to end up over trading, and you're going to end up at some point having a big problem. So effectively what we're saying is that we should treat 10% net profit now as the new break-even. So forget thinking about 0% or break-even, think about 10% as that break-even. So now that we've done that, we want to start thinking about how this new P&L, or this Smart P&L, looks. So it's pretty similar to what it was before, but we'll notice that there's a couple of extra lines. So what we've said before is we're going to focus on the gross margin, which is in bold there, but to get to that, we're going to take out all our materials, and if we have outsourced direct labour, we're going to take that out, but we're not going to take out our internal labour costs, because you'll see that comes a couple of lines below. So we end up with a gross margin and a contribution margin. So the contribution margin is effectively what you would probably normally consider as your gross margin. That's what your would have been included there before. We've just split out the direct labour costs, the internal direct labour costs, separately. So you've got two lines there. And then you'll note below that, out of the other fixed costs, we've split out any other key labour. Now, we'll all have some management labour costs, because that will probably be us at least, but there should be some management. We won't all have sales labour costs, but if you've got a sales team, then it makes sense to split those out of the other fixed costs within there, because then we can calculate a couple of ratios in a minute. So then we're down to our pre-tax profit, and our as I said before, whether we report the percentage as a sales, as a percentage of the sales, or percentage of gross margin, depending on what kind of business we're in. So it's not very much more complicated, and as I mentioned before, within there we will be treating our owners' salaries in the correct way with the market rate. So that then allows us to calculate some ratios which will help us to monitor our efficiency of our labour and our productivity over time. So we can do a direct labour ratio, which is, and we're simply dividing the gross margin by the direct labour cost, the internal direct labour costs, and it will be a number like 3 or 4 times. So that basically will be saying, if it was 3, that would be saying for every dollar that we make on gross margin, every dollar, what is a dollar for? Every pound that we spend on direct labour, we would get 3 back in terms of gross margin. That was our ratio. Similarly with sales, but we use a contribution margin for sales, and similarly for any management labour ratio, we would use a contribution margin for that. So we're dividing either the gross margin or contribution margin by whichever labour cost we're looking at, and that gives us a ratio. It gives us a number, which you'll see in a minute how that can be used to monitor over time. So if we're running a manufacturing company and we're trying to improve the productivity and efficiency of our labour force on the shop floor, then the direct labour ratio is a really good overall measure. We might be doing some other things at a more granular level, but that overall ratio is a really good one, and it will give us a unique insight into our business as we grow and as we scale. So now it's going to get really complicated. So I can see Caroline here, and I can see, I'm sure everybody else here is going, this is where your head really starts out, because I'm going to put some actual numbers in here. But again, you can look back at these and have a good look later. So this is just an example. We're turning over £500,000, and at the bottom we're making a 6% net margin, and the ratios are calculated as there. So you can see that the direct labour ratio is 4, the sales labour is 10.8, and the management labour is 5.4, which on their own don't mean anything, because we don't know whether they're good or they're bad, but we know we're making 6%. So if we're making 6% net profit, then according to that definition earlier on, that framework earlier on, we're just out of life support. Okay? So we're probably in the recovery unit at the minute, but we're being very closely monitored. So we don't want to be taking on more staff. We don't want to be taking on more costs in a minute. We've got to have a drive on productivity and efficiency to try and get ourselves initially to that 10% sort of type level. So that's the first target that we would want to set ourselves, is get to 10% whilst holding the cost constant. So we don't want to spend our way towards the 10%. We want to improve our productivity. There might be a political message in there somewhere as well, I'm not sure, but we don't want to spend our way out of trouble, because it won't work. We want to improve our productivity. So that may mean changing one or two employees. It may be that we see that we want to change some employees. It doesn't mean you've got to absolutely stick with exactly what you've got. If you've got people that aren't performing, then obviously you should change that around. But what we don't want to do is take on any additional labour costs particularly. So, and as I said before, the solution to what we need to do is simple. The actual doing it is not simple. We know that, but at least we know what we've got to focus on. And this is kind of where some of the other webinars and the other stuff that we've talked about scaling up starts to come in, and finding ways to improve the productivity and the profitability. We've talked about 7 financial levers and things before, but this is where all of this stuff comes into play, and we've got to really focus on that. But to get that 6% up, and then the next step, we get to our 10%, and you'll notice that therefore we have grown. Because that's where we're assuming we're a naturally growing business, or the business is growing. So we've grown, but we've not taken on any more labour costs. So you see the labour costs have stayed the same, and obviously the cost of materials and all the variable costs will vary as the sales goes up, but the labour costs won't. Same with the management and the sales labour costs, as well as direct labour costs, they've all stayed constant. And we've got ourselves to 10%, and you can start to see what's happening with some of the ratios down there as well. So that's great. At this point, we will probably reset, see if there's any staff that are particularly struggling with the way that we're doing things, and if it's that's another good point to just start thinking about, okay, have we got the right people in here? But we reset, and then we go forwards to our 15%, still with the same cost base. That's what we want to be doing. Now look at the ratios. So this is now telling us that when we get to 15% profitability, those are the kind of ratios that we want. And at this point, we can start to see where there's a stress point. It might be that we're really struggling on the shop floor. The direct labour now is really creaking because we really had to push people. And I think, okay, well maybe that's then where we take the staff on, or it might be that it might be across the board. It might be direct labour, sales and management. Actually, we want to do it. But the thing here now is we can start to think about either taking on more people or possibly rewarding people with bonus structures or whatever else. But we can spend a bit more money now on making our on our labour, basically, at that point. But we only do that to the point that it takes us to 10%. We don't do loads of it to the point where we can't, where we've gone below 10%, because remember, we want to go up to 15 and back to 10 ideally is what we're trying to do. So I've just highlighted a few figures here now, and we've added a few costs across the 3 labour side of things here, and our pre-tax profits gone back to 10%, and our ratios correspondingly have changed as well within that. So and as those ratios change, if you do this and you do this over time, obviously, you will get a really good feel as to those ratios and how that translates. So you'll know when you're effectively overheating within your business, and you need to add people. You'll know likewise if you're running slack and you need to make adjustments because some of those ratios have changed. So it gives you a slightly more finer thing to look at, more sensitive than just simply the pre-tax profit. So, and there's just the final one getting us back to 15% again. So the key lesson here, just out of those numbers really, is take it slow, add one key role at a time when you're scaling up. Don't try and spend your way out of trouble in terms of your staff, and get back to that 15% sort of level of profitability before you think about taking on anybody else. So, you know, we have covered quite a lot of detail within this. I hope your head doesn't hurt too much. If that was a bit quick, which by the nature of these webinars it will be, Caroline will send out the webinar links, so you can go back and you can look at that. You can look at the slides as well, and you can work out what we've done with the numbers. But let me just summarise what we've learned. I sound like a school teacher here, but you know what we've learned. So, and the first is that, you know, P&Ls, whilst the basic ones are pretty simple and we get our head around them, they can be distorted. You know, they've got the owner's compensation, not market rate we talked about, and the gross margin we talked about. So we need ideally to have those 2 sets of books, the ones that we would use to report back to HMRC or whoever with, but also the set that we can use to really make our business decisions internally with. And within that, we want to redefine that gross margin, because the original definition of gross margin mixes labour and non-labour costs, so we can't separate out the labour costs and work on the efficiency of our labour and our productivity. We want to treat 10% as a new break-even, and we should be thinking about, when we scale, doing it in steps, but managing that profitability so it's sustainable. So we're thinking about trying to get up to the 15 before we take on more staff costs. So so we make sure that we have that focus on the productivity as we go. So that is all I wanted to cover today. Thank you.
Great. Okay. Thank you very much, Kevin. Let's see if you do have any questions. Okay. Yeah. The first question is from Ian, and he asks, how often should I review my P&L?
Okay. Thanks, Ian. So ideally, I mean, many of us would say we're probably just looking at them once a year. That's not good enough if we're going to do our business decisions on it. So what we want to do is to do these monthly. And if we're using things like Xero, it should be relatively straightforward to do it. But also, this is where I was saying it's worth investing a little bit into the accounting side. So if you've got a good bookkeeper that works with you, work with them to produce the numbers in the way that you want, and have a look at them every month, and then that will help you certainly in going forward business decisions. So monthly will be the answer to that one.
Okay, great. You've got a couple of questions here from David. In a service business, how would you split direct labour costs with, for example, management labour, if both management and labour help deliver the solution?
Great question, David, really good. What you want to, if you've got somebody that is 50% or more in terms of doing the do, helping you produce whatever the product is or the service that you're running, David, then they should go into the direct labour costs. So what you don't want to do is split people across, and say, oh well, they're 45% here and 30% there and whatever the rest is somewhere else. You don't want to do that; it just gets too complicated. If half or more of their time is spent in direct labour producing the service or product, put them into that box. Okay?
Okay. And he asks, is it possible for a sample Excel sheet to give the headings, etc., to translate and split our existing P&L?
I can certainly do that. We can send out the spreadsheet that I use to generate those slides. No problem. Absolutely can do that, David.
Okay, perfect.
Good.
I think those are all your questions.
Brilliant.
Okay,
thank you.
So thank you again, Kevin, for hosting today's webinar. As Kevin said, I will be sending out a copy of the presentation and a link to the webinar recording. But please do email Kevin direct if you have any further questions. Before we close, just a quick reminder that this webinar is part of our service to our Smart Room members. If you're not already a member or a BizSmart client and would like to access our archive of webinars, then please do visit our website, biz-smart.co.uk, and go to the Smart Room page. That's the end of today's webinar. Thank you all for listening, and we hope you can join us again very soon.